For most of this year, the shilling has remained relatively stable, buoyed by the central bank's increased efforts at forestalling a repeat of the rapid depreciation that saw the local unit dip to an historical low of 107 shillings to the US dollar in October last year. However, the last 2 weeks have seen the beginning of a rapid reversal of this year's gains, causing the shilling to experience swings almost reminiscent of last year's volatility.
We've seen the demand building up.
Earlier Thursday, the shilling's performance against major world currencies had created a tense trading session, at one time looking like it would breach the 89 shillings mark when it touched 88.70 to the US dollar before easing off to close at 86 shillings and 10 cents. According to traders, the performance was a combination of end-month dollar demand and speculation, which they say is nothing to be worried about as supply and demand fundamentals remain strong.
It's not really something to worry about. I don't see us repeating what we saw last year where we went above 100, 107. But nonetheless, the shilling will always be under pressure.
The central bank has been frequent in the market to purchase dollars so as to ease pressure on the shilling. Though traders maintain that the shilling swings could be attractive for investors, lower inflation could impact the currency negatively.
When inflation drops, people expect rates to follow. And that is always a negative for a currency. It puts the currency under immense pressure because people will move from that currency to higher yielding currencies.
But for those hoping to see the shilling strengthen to levels such as the 16 shillings to the dollar last seen in the 80s, it will be a long wait as such a strong currency will not be supportive of fundamentals currently driving the economy. Wanjiru Gaitho, Citizen Business.